we're halfway into the next recession. Yes, this is correct. Recession is just 2 consecutive quarters of falling GDP, and in the first quarter of 2022, GDP unexpectedly fell by 1.4%. Just one more quarter of similar economic performance, and we're officially in a recession. With continued economic uncertainty both domestically and internationally, real estate may be one of the few anchors of financial stability available to individuals and small investors. In this video, I'm going to unpack what our current economic situation means for home buyers and home sellers, and if it's still a good time to buy or sell a home. This is Michael Tallis with the Tallis team. If you have any questions about anything related to the Bay Area real estate, call or text me at 650-766-6100. I also put this number in the description of this video. Without further ado, let's jump right in. The recessionary winds are not the only challenge the economy and the housing market are facing these days. Inflation so far this year reached 8.5%, the highest level since 1981. Last year, inflation was only 7%, when we hoped that the inflation was transitory and would recede this year. Some analysts predict that we reached the peak already, but we have to wait and see if it's true. To counteract the inflation, the Fed's increased rate by 0.5% at their May meeting. It is expected that they will increase the rate by 75 basis points at their June meeting. The Fed has not increased interest rate by 75 points since 1994. A 75 basis point hike in June would increase the rate to target range of 1.5 to 1.75%. Stock market is unstable. Dow Jones Industrial Average lost more than 11 points since the beginning of the year, and Nasdaq almost 26. Many Bay Area companies are looking for ways to improve profitability. For example, Facebook parent Meta Platforms slows hiring as it looks to cut cost. In another example, Netflix is changing how it pays workers. Netflix Inc. has long made a point of giving managers freedom to pay what they wanted to attract and retain employees. They may not have that freedom much longer. And some other companies like Bay Area startup Main Street is cutting their workforce by 30%. Mortgage interest rates were growing since the beginning of the year at an unprecedented rate. 30-year fixed-rate mortgage now firmly sits above 5%, the highest level since 2010. With the Fed rate expected to grow, the mortgage rate should end the year in high 5 to low 6% range. On top of that, we experience effects of the war in Ukraine and COVID lockdowns in Shanghai, Beijing, and other Chinese cities. The disruption in the supply chain are hard to predict given the secrecy level of the Chinese government. The war in Ukraine is the largest armed conflict in Europe since the end of the Second World War. It is especially disruptive to the world economy because all countries involved in the conflict are large food and fertilizers exporters, not just oil producers. With all this instability, real estate is emerging as a safe haven, one of only few hard asset classes people flock to for security, like precious metals and fine art. Historically, home values were recession-proof. Home values decreased only twice since 1980s. One was the saving and loan crisis in the early 90s, when the property values decreased by only 0.9%, and the Great Recession, the housing market crash that was triggered by lending practices of our own industry. If the past is any indicator of the future, the next recession will resemble dot-com crash, not the Great Recession. During dot-com crash, the housing values across the country increased by close to 5%, 4.8% to be exact. And there are very good reasons to be optimistic about the real estate market. Over the last 10 to 12 years, the tighter lending standards created an economic sector with very strong fundamentals. First of all, there is a huge amount of equity in the market. Because of this high equity, the wave of the foreclosures were expected at the beginning of COVID never materialized. At this point, only 1.3% of loans are in some kind of forbearance program, and most of these borrowers have a way to get out of the program. Currently, there is only 17% of the delinquent borrowers who have no plan in place. And California is doing very good on mortgages, better than elsewhere. 96.8% of California mortgages are current. And the amount of foreclosures almost non-existent. Look at the size of these orange bars comparing with the crisis years or general historic averages. These improvements in the delinquency rates and the foreclosures were driven by tight lending standards. Look at the difference in the amount of loans issued to borrowers with low credit score, 620 or lower, before the crash and after the crash. And on top of that, we see the number of first-time homebuyers reaching 10-year high, as well as the highest in 10 years home ownership rate. Nationwide, we expect demand for homes to continue being strong and home values increasing by about 9% this year. The local market is not showing any signs of slowing down either. April median home sale price was up by 16.6% since last year and 3.1% up from the month before. Average overbid, sale price over list price ratio in April was 13.7%, up from 7.9% same time last year. And the average time on the market dropped to 11 days, down from 16 days in April of 2021. The median time on the market is only 7 days now. Half of the homes that come to the market sell in 7 days or less. What does it mean for the buyers? It is still a great time to buy a home. The real estate market will provide you with a great measure of financial stability in the current fluid and uncertain economic environment. If it is the right time for you to buy a home, based on your personal situation, monitor the market for new listings daily so you won't miss any buying opportunities. Communicate your search criteria to your realtor so I can help you with the search. Before submitting an offer, make sure to talk to your lender. With the interest rates changing daily, if not hourly, ask them to verify that your loan pre-qualification stays current and lock the interest rate as soon as your offer is accepted. In response to the interest rate increases, lenders are coming up with new products that may help you offset the increased borrowing costs. Ask your mortgage broker if the program you selected originally is still the best for you. You may want to switch to an ARM program, adjustable rate mortgage, instead of 30-year fixed loan, or go for an option with a different down payment. For example, an ARM loan will be a great option if you're planning to stay in the new home for 5, 7, or even 10 years, if you're not buying your forever home. If you're relying on the stock market investment for your down payment, you may want to cash out of the market and prepare your down payment ahead of time. This will protect you from the stock price fluctuations. Also, if you are selling your stock, make sure to set aside money to pay your income or capital gain taxes. Talk to a financial advisor to make sure you set aside sufficient funds. We've seen people forced to sell their home in order to pay off their tax bill. And if you're a seller, it is also a great time to sell your home. Recessions are typically the best time to move up in the housing market. The luxury segment will often be the first to adjust to recessionary economic conditions and provide you with ample opportunities to buy at discount prices. You have to be extra careful, however, when you accept offers for your home. Make sure that the buyers present the latest and the most up-to-date financial information when they submit the offers. Verify that they are still qualified for the loan and have sufficient down payment and reserves to close the deal. This is Michael Tallis with the Tallis team. If you are thinking about buying, selling, or investing in real estate, call or text me at the number in the description of this video. I am looking forward to helping you navigate this challenging housing market.